Let me paint you a picture. You're 28 years old. You've got a stable job, a 401k you set up during onboarding because HR told you to, and absolutely no idea what's inside it. You've picked a handful of funds with names that sound serious. Things like Strategic Growth Portfolio and Diversified Balanced Opportunity Fund. And you feel responsible, like an adult, like someone who has their life together. And you do this for 35 years. You contribute faithfully, you ignore the statements because they're confusing and life is already confusing enough. You tell yourself, someone smarter than you is handling it. And then, at 63, you open up your account and realize you're about $340,000 poorer than you should have been. Not because you didn't save, not because the market tanked, not because you did anything wrong, but because of a number so small you probably never noticed it. A number that looks like this, 1.2%. That's the average expense ratio on actively managed mutual funds in the United States. 1.2%. Sounds like nothing. It sounds like the rounding error. It sounds like the kind of number you'd see on a parking receipt and completely ignore. But over 35 years on a $200,000 portfolio, that 1.2% doesn't just chip away at your returns. And by the time you figure out what happened, the money is already gone. And nobody's going back to prison for it because it's all perfectly legal, perfectly disclosed in documents nobody reads, and perfectly profitable for everyone involved except you. Welcome to the $17 trillion retirement industry, where the product is your future and the business model is your confusion. Let's start from the beginning, because this story doesn't start with some villainous boardroom meeting where executives twirl mustaches and decide to rob retirees. It starts somewhere far more boring and honestly, far more sinister. It starts with the concept of financial advice itself. Because here's a question nobody asks out loud. Why does the financial advisory industry exist? The surface answer is obvious. Markets are complicated. People need help. Advisors provide guidance, build portfolios, and make sure you don't do something stupid like dump your entire 401k into your brother-in-law's hot sauce company. But the deeper answer is less flattering, because the financial advisory industry, at its structural core, is a distribution network, a sales channel, a mechanism for getting ordinary people to buy financial products that generate fees. And the people selling those products are often compensated not based on how well your money grows, but based on how much of it they can move into fee-generating vehicles. This is not a conspiracy theory. This is the documented, publicly available, legally disclosed business model of an industry managing over $17 trillion of American retirement savings. Let's talk about how it actually works. There are two types of financial advisors. The first type is a fiduciary. A fiduciary is legally required to act in your best interest. That's it. That's the whole thing. They have to put you first. The second type is a broker or broker-dealer representative. They operate under something called the suitability standard, which means they only have to recommend investments that are quote-unquote suitable for you. Not the best, not the cheapest, not the one that makes you the most money. And here's where it gets fun. For most of modern financial history, around 90% of the people calling themselves financial advisors were operating under the suitability standard, not the fiduciary one, meaning your advisor had no legal obligation to recommend the best option for your portfolio. They just had to recommend something that wasn't insane. And within that enormous gray area, they could steer you toward products that paid them the highest commission. This is not illegal. This is Tuesday in the financial services industry. Now let's talk about where those commissions actually come from. Because this is the mechanism, this is the gear turning inside the machine that nobody explains to you during the onboarding meeting. When a financial advisor recommends a mutual fund, that fund often pays the advisor a commission. This commission is called a load. You've got front-end loads, which hit you the second you invest. You've got back-end loads, also called deferred sales charges, which hit you when you try to leave. And you've got 12B1 fees, which are ongoing annual fees buried inside the fund's expense ratio that flow directly to whoever sold you the fund in the first place. So, the advisor gets paid on the way in, gets paid on the way out if you try to leave early, and gets a little kickback every year in between just for keeping you there. And all of this is disclosed. Technically, it's in the prospectus, the same 300-page document nobody has ever read voluntarily. It's the financial equivalent of terms and conditions, and the entire system is designed with the quiet confidence that you will never read it. Now let's talk about the actual cost of this, because this is where the numbers go from annoying to genuinely enraging. The average actively managed mutual fund charges an expense ratio of around 1.2% per year. The average S&P 500 index fund charges 0.03%. Let's actually do the math, because the math doesn't care about your feelings. Let's say you invest $200,000 at age 30 and never touch it until age 65. That's 35 years. Assume the market returns a fairly standard 8% annually. In an index fund at 0.03% fees, your $200,000 grows to approximately $2.96 million. In an actively managed fund at 1.2% fees, your $200,000 grows to approximately $2.13 million. That's a difference of $830,000, not from better performance, not from smarter decisions, just from fees, just from that 1.17% gap. And now, here's the gut punch. The actively managed funds charging you that extra 1.2% per year, they don't even outperform. In fact, over a 20-year period, over 90% of actively managed funds underperform their benchmark index. That's not a typo. 9 out of 10 of these funds, the ones charging you extra, the ones where some guy in a suit is supposedly earning his fee by picking the right stocks, fail to beat the market they're compared against. Over 20 years, they lose. And that's before the fees. Once you factor in the fees, the performance gap widens even further. So, to recap, you're paying more money to get worse returns. And the person selling you this arrangement is legally permitted to do so as long as the product is deemed suitable for your situation. This is the retirement trap, and most people are in it right now and don't know it. Now let's meet someone who figured it out the hard way. His name is Brian. Brian is 59. Brian did everything right by conventional standards. He had a financial advisor his whole career, a nice guy named Greg who sent him a holiday card every December and called once a year to review his portfolio. Brian trusted Greg. Greg wore a nice watch. Greg had a diploma on his wall. Greg had a handshake that said, "I've got this." What Greg also had was a book of funds, each with expense ratios between 0.8% and 1.5%, and a portfolio that had trailed the S&P 500 by an average of 2.3 percentage points per year over the last 15 years. Brian found out about this because his son, who had started investing on his own at 24 into index funds, had accumulated nearly as much as Brian had at 59. Same contribution rates, roughly, different fee structures, wildly different outcomes. Brian didn't lose money. His portfolio grew, but he grew significantly less than he should have. And the uncomfortable realization isn't that Greg was evil. Greg probably believed he was helping. The uncomfortable realization is that the entire system Greg operated inside was built to extract value from Brian. And it did exactly that for 30 years, and with a holiday card every December. And Brian's situation is not rare. Brian is the median American investor. Brian is the rule, not the exception. Here's something else that never gets talked about: the emotional engineering built into this industry. Because one of the main selling points of an active fund or a financial advisor isn't performance, it's comfort. It's the feeling that someone is watching, that when markets go crazy, there's a professional at the wheel making smart decisions. But here's the irony: that comfort, that feeling of being managed, tends to make investors worse. Because when people feel like a professional is handling things, they're less likely to educate themselves. They're less likely to ask hard questions. They're less likely to notice the 1.2% quietly compounding against them for 35 years. The comfort of the product is actually the mechanism of the trap. Which brings us to something I haven't mentioned yet, and that's the role of the 401k plan itself. Because most people assume that their company's 401k is optimized for their benefit. That HR vetted the fund options, that someone in a corporate tower made sure the funds inside are good. They didn't, or at least that's not the primary filter. What actually happens is a 401k plan administrator, often a large financial institution, puts together a menu of funds for the plan. And those funds often pay what are called revenue-sharing arrangements back to the plan administrator, meaning the funds inside your company's 401k may have been selected, partly based on how much they pay the plan administrator to be included. This is called a kickback in some industries. The Department of Labor has spent years trying to close some of these gaps. Some progress has been made, but the core architecture of an industry designed to maximize fee extraction while appearing to serve your retirement interests remains largely intact. Let's talk about what you can actually do, because this video isn't meant to make you feel helpless. It's meant to make you feel informed, and there's a meaningful difference. Here's the practical framework. First, find out what you're actually paying. Log into your 401k or brokerage account right now. Look up the expense ratio on every single fund you hold. Write the numbers down, add them up. Then multiply your portfolio value by that number. That's approximately what you're paying in fees every single year. If it's more than $1,000 and your portfolio is under $500,000, that number should make you uncomfortable. Good. That discomfort is useful. Second, understand whether your advisor is a fiduciary. You can ask them directly. The answer is either yes or no. If they dodge the question or they say something like, "I always act in your best interest," without actually saying the word fiduciary, that's your answer. If they're not a fiduciary, they can legally recommend products that benefit them over you. That's the arrangement. Know what arrangement you're in. Third, look at your fund's actual performance versus its benchmark. If your actively managed large cap fund has underperformed the S&P 500 over the last 10 years, the fund manager is not adding value. They're subtracting it, and you're paying them extra to do it. This is publicly available information, and it will take you 4 minutes to look up. Fourth, understand that the simplest option is often the best one. A 3-fund portfolio, a total U.S. market index fund, a total international index fund, and a total bond market index fund held in low-cost ETFs from Vanguard, Fidelity, or Schwab with expense ratios below 0.1%, will outperform the overwhelming majority of actively managed alternatives over a 20-plus year horizon. Because low costs compound just like fees do, except they compound in your direction. Fifth, if you have a 401k with bad high-fee options and your employer offers a match, still take the match. The match is free money, and it outweighs bad fund options up to a point. But after you've captured the match, consider maxing out a Roth IRA or a traditional IRA in lower-cost funds before putting more into a high-fee 401k. Sixth, ask your plan administrator about index fund options inside your 401k. Most plans have at least 1 or 2 index fund options buried in the menu. They might not be highlighted, they might not be the default, but they're usually there. None of this is complicated. None of this requires you to become a professional. What it requires is about 90 minutes of your time and the willingness to look at something that was specifically designed to be ignored. Here's where I want to leave you. The retirement industry is not staffed entirely by villains. Most of the advisors in it genuinely believe they're providing value. Most of the fund managers genuinely think they can beat the market. But belief doesn't change the math. And good intentions don't refund your $830,000. The structural reality is this. An industry managing $17 trillion has a very strong financial incentive to make sure the conversation about fees stays as boring and confusing as possible. Because the moment ordinary people understand what compounding fees actually cost them over 35 years, the demand for expensive actively managed funds collapses. And that's bad for the industry, even if it's spectacularly good for you. The single biggest financial improvement most Americans could make has nothing to do with picking better stocks. It has nothing to do with timing the market or following some influencer's portfolio. It's simply moving money out of expensive funds and into cheap index funds. That's it. That's the whole alpha. And an entire $17 trillion industry is financially motivated to make sure you don't realize that. Now, I want to hear from you. Because everyone's situation is a little different, and people land in very different places on this. So, here's the question. When you look at your own retirement account right now, do you think you're in A, a low-cost index-focused setup, and you've already thought about this? B, an actively managed situation you've never really questioned until just now? Or C, you have absolutely no idea what's in your 401k, and this video just sent a very specific type of anxiety through your chest? Drop your honest answer in the comments, because I genuinely like to know how many Brians are out there. And if you know someone who's been trusting Greg for 20 years and has never looked at an expense ratio in their life, send them this video. Because sometimes the most expensive thing you can do in markets isn't a bad trade. It's simply not paying attention to the fine print.